Hello and welcome to the channel of Sigma Plus Industrial Solutions. And today in that video, we will continue our discussions about the cost savings. This video is considered to be part 3. In the last videos, part 1 and part 2, we've been discussing about the cost savings that could be generated by improving the capacity utilization. In that video, we will focus our discussion about the cost savings that could be generated by improving the operation and the cash cycle. But first of all, we need to understand what's the meaning of the operation and cash cycle. So the operation cycle usually starts from the time that the company releases all the purchase orders to buy or to purchase its required inventory, passing through all the production operations that transform the raw materials into finished goods and products, and later on delivered to the customers, passing through the terms of payment collections from the customers, and getting all the payments from the customers to the company. At the end of the payment collection, we consider that the operation cycle is closed. So in other way, we can say that the operation cycle is the length of the time between the purchasing inventory and receiving the cash from the sales. And it can be calculated from the shown formula, which is the inventory period plus the accounts receivable period AR. The cash cycle is the length time between paying the inventory and receiving the cash from the sales. Okay, and it can be calculated through the shown formula, which is the operation cycle minus the accounts payable period, which is short-term to AP. Now, to better understand those terminologies, let's reflect those definitions on the figure in front of us. So the first terminology, which is the period of the inventory, which starts usually by the time that the company releases the purchase orders to purchase all its required inventory for the production operations. And it ends up till the time that the inventory had been completely sold. And what do I mean with the inventory sold here? That we have delivered all the products and the services required by the customer to the customer, and they are not anymore existing in the company site. And they have been well delivered without any kind of quality issues. And this is what it's known with the inventory period. So the period of an inventory starts from the time of buying the inventory till that we have delivered all the products and the services to the customer. After that, it comes the period where we get the payment collection from the customer, and this what it's known with the accounts receivable period. I would like to highlight one small point, which is, in fact, those kind of sales are known to be credit sales. It means that the company is taking a debt from the bank to buy and purchase all the required materials to perform the production operations and transform it to finished goods and delivering to the customer. Okay, so there are some kind of financial accounts. Based on that, the customers will have to pay to those financial accounts, and that's why we call it accounts receivable, because the customer will be paying back the cash into those accounts. So the operation cycle will be the period of an inventory plus the period of the accounts receivable, or the period where we are collecting back the payment from the customers. So we've been speaking about the inventory period, we've been speaking about the accounts receivable period, but what about the accounts payables? And the accounts payables, it's the period from the time that the supply chain management is releasing all the purchase orders to the vendors and to the suppliers to purchase all the required inventory and materials till the time that the company had paid 100% all the bills and the cost of the materials to the supplier. In fact, this period is considered to be a critical one. Why? Because it's affecting the cycle cash. And as a benefit to the company, it's important for me and for my benefit as a company to manage that time to make it as larger as possible. But in fact, this will not be something easy, because not all the suppliers and the vendors will be happy and flexible with that. And that's why it will require some kind of strong skills in negotiations with the suppliers to reach a consensus agreement and a win-win situation for the period of the accounts payables between the company and the suppliers. So if we know now the operation cycle that start from the time that we buy the inventory till the time that we receive the cash from the customers, and we know the accounts payable period, so it's easy for us to understand and to know where is the cash cycle, as the cash cycle is the difference between the operation cycle time or duration and the duration of the accounts payable. Okay, now another terminology which is considered to be important is the turnover, and the turnover is widely used in the financial statement sheets, where it refers to the number of times a year that the average amount of inventory, receivables, and the payables are sold or recovered or paid. So going to the first type of the turnover, the inventory turnover, which refers to the number of times a year that average inventory is sold. And the inventory turnover can be calculated through the shown formula by dividing the cost of the goods sold, the COGS, by the average inventory. And the inventory period can be calculated by dividing the 365 days of the year by the inventory turnover. Now, going to the second type of the turnover, the accounts receivable turnover, and which refers to the number of times a year that the average accounts receivables is covered. And the accounts receivable turnover can be calculated through the shown formula by dividing the accumulated credit sales by the average accounts receivable. And the period of the account receivables in days can be calculated by dividing the number of days per year, the 365 days, by the accounts receivable turnover. The third type of the turnover, which is known the accounts payable turnover, and it refers to the number of times a year that the average accounts payables is repaid. And it can be calculated by dividing the cost of the goods sold, the COGS, by the average accounts payable. And the period of the accounts payable in days can be calculated by dividing the number of days per year, the 365 days, by the account payable turnover. Okay, I understand that we've been speaking a lot about theoretical rules and formulas, but let's take an example to practically understand how can we utilize those formula to measure and assess the cash flow in a certain company. So consider a small scale enterprise like a workshop that has an annual revenue or credit sales of $200,000 and a cost of goods sold of $93,500. The yearly start of the inventory was $45,000 and ended with $52,250, which means that the value of the materials existing in the warehouses and the value of the products, the work in progress in the production lines, and the finished goods that still kept in the company was $45,000 at the month of January. While in the month of December, the value of the total value of the inventory was found to be $52,250. And the second information that I have is that the yearly start of accounts receivable was $21,300 and ended with $39,450. So what does it mean? It means that in the month of January, the company had a cash in from the accounts receivable from the customers of $21,300. While in the month of December, the company had a cash in from the accounts receivables from the customers of $39,450. The third information that I have is that the yearly starts of accounts payable was 32,500 and ended with $41,500. It means that in January I had a cash out, which were the payables to the suppliers of $32,500, while in December I had submitted a cash out to the supplier of $41,500. So now let's start to solve that example and try to express the cycle of cash for that company. So the first KPI that we can calculate is the inventory turnover, and the inventory turnover is by dividing the cost of the goods sold by the average inventory. So the cost of the goods sold per the year, the complete year, was $93,500, and the average inventory, which is the inventory in January, which was $45,000, and the inventory in December was $52,250, which makes an average of $48,625. So by dividing the cost of goods sold, the 93,500 over the 48,625, it will give me the inventory turnover 1.9 times, which means that the inventory turnover is 2 times per year. Each 6 months, I'm changing the inventory. Okay, so the inventory period will be by dividing the 365 days by 1.92, which is approximately 2. So it's almost 190 days, which means that this is the average number of days that my inventory kept in the warehouses. Okay, now the second KPI, which is the accounts receivable turnover, and this is calculated by dividing the accumulated credit sales, which is $200,000, by the average accounts receivable. Remember the cash in January and the cash in December, and the average of the cash in January and December was found to be $30,375. So by dividing the credited sales or the annual revenue of $200,000 by the 30,375, it will give me the turnover of the accounts receivable, which is almost 6.5 times. So I can say approximately 6 times I'm receiving the cash back on a yearly basis from the customer. And the accounts receivable period will be by dividing the 365 days by the turnover, the 6.58, which is equal to 55 days approximately, which means that I'm getting my cash back each 55 days, which is somehow showing good and healthy compared with the inventory period, which looks for me quite longer than required. Okay, the third KPI that we need to calculate is the accounts payable turnover by dividing the cost of goods sold by the average accounts payables. So that will be the 93,500 by the 37,000, which is the average of $32,500 and the 41,500. And this is giving me an accounts payable turnover of 2.5. And if I look to that number, it seems okay with me. It looks nice because this means that at least the supply chain management, they are a little bit implementing some efforts and controls in submitting the purchase orders to the suppliers, and that means that the accounts payable is happening every 146 days. Okay, so the only comment, the first comment that we can highlight here is about the inventory period, and that, in my opinion, could be the bottleneck to improve the cash cycle. And this is what we are going to learn in the next slide. But before that, we can calculate now the cash cycle, right? So first of all, we have found an inventory period is 190 days. The accounts receivable period is 55 approximately 55 days. So the operation cycle, which is the period of the inventory plus the period of the accounts receivable, is 245 days. And the accounts payable cycle is 146 days. So the cash cycle will be the net between the 245 days and the 146, which is approximately the 90 or 99 or the 100 days. So let's now better express what does it mean that having a cash cycle of 99.6 days, and what can be done better to improve the cash cycle. So we need also to understand what will be the effect of having a larger cash cycle days or a shorter cash cycle days. So in that scenario, if my cash cycle is 99 days, which means that I should have a cash cycle turnover of about 3 to 4 times per year by simply dividing the 365 days by 99. So what does it mean? It means that if I am operating a cost of, if my cost of goods sold was 93,500, which means that I have operated an annual investment of $93,500, right? But in that scenario, I have a turnover of 3.6. So that means that I've been approximately operating a monetary value of $25,400 approximately each 3 to 4 months. Okay. Now, recalling back the monetary value that it is decreasing over the time. We've been discussing in last lessons, in the lesson of the net present value, when we discussed that any money has a depreciation value over the time, and there is an interest rate or a depreciation rate over the time, right? So if I consider that my bank interest was 11% and my cash cycle turnover was approximately 3.5 or 4 times per year, so that means that I've been operating a $25,407 dollars 3 to 4 times per year, which means that I had a loss interest in the monetary value of the $25,407 of $2,794. Okay. Now the question is, imagine if I try to reduce the cash cycle, if I put a target to reduce the cash cycle by 10% by focusing on implementing any lean tactics to faster the delivery in the production lines, to control the WIP in the production line, and I could reduce the inventory period in such a way that I succeed to reduce the cash cycle from 99 days to 90 days, which is about 3 months. And this is approximately, as I mentioned, about 10% reduction in the cash cycle. What will be the effect of that? In that case, the cash cycle turnover will be 4 times per year, which means that the $93,500 will be operated 4 times per year with a monetary value of $23,375. Considering the depreciation rate of 11%, it means that the monetary loss will be approximately around $2,571. So if I compare this scenario with the first one, I will see that I could make a saving of $223 compared with the first scenario, right? Because in the first scenario, when the cash cycle turnover was 3.68, my interest loss was $2,794, compared with the interest loss here is $2,571, which means that I have generated or avoided a cost saving of $223. Okay, the third scenario. Imagine if you have done a breakthrough improvement in the inventory period, and you have reduced the cash cycle 60%, you went down from 99 days to 30 days to 1 month only. So what does it mean? It means that the cash cycle jump from 3.6 times per year to 12 times per year. What does it mean? That you have been operating the investment of $93,500 instead of 3 to 4 times per year to 12 times per year. So that means that you have been operating the $7,791 12 times per month. So what's the difference here? The difference here that the annual interest depreciation will go strongly down, okay, which is the 11% out of the $7,791, and it is equal to $857. What does it mean? It means that you have generated a cost saving of $1,937. So we can understand from that dummy example how can we generate more hard savings by just improving the cash flow. And this can be done by controlling the inventory, by delivering the products in good shape and good quality to prevent any hold for the payment from the customers. Sometimes the customers might complain from incomplete products or from quality issues from the product. So as far as that you are reducing the inventory period and you are reducing the accounts receivable period, you are reducing the total operation cycle, then in this case you will improve and or reduce the cash cycle. And that's from where we can get the hard savings from the cash flow, by having a healthy cash flow for the company. Now that was a dummy example for a small workshop, but imagine now for the large scale companies, that instead of that they are performing revenues of $200,000, they are doing for 200 million or $1 billion. Imagine what could be the savings, the hard savings that could be generated by improving the cash flow and reducing the monetary loss value by improving the cash cycle turnover. This is why what you need to apply your imagination and reflect those what you have learned today from that example in a larger scale business, where you can see the real hard savings that could be generated from improving the operation cycle and the cash cycle. Okay, so as a summary for that, the lesson of today, the cash cycle is one of the several measures of management effectiveness. It measures how fast a company can convert cash on hand into even more cash on hand. When a company takes an extended period to collect outstanding accounts receivable, has too much inventory on hand, or pays its expenses too quickly, it lengthens the cash cycle. And of course, this is not good. What we are always looking for is to reduce the cash cycle. And a higher or quicker inventory turnover decreases the cash cycle, right? And shorten the cash conversion cycle to improve your return on investment. Okay, I hope that you got a new learning lessons today. I thank you for your watching and good listening, and see you in the next videos. Thank you.